Stock investing is complex, and building a portfolio that meets your financial objectives is no simple undertaking. The ideal amount of stocks you should keep depends on a variety of factors, one of which is diversity. But this isn't enough info, is it? You're probably wondering, how do I diversify my assets and how many should I own? Lucky for you, we're answering that question today. Hey, welcome to Stock Market Mate. Today we'll tell you how many stocks you should own. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Earlier we mentioned diversity. Let's take a closer look at the value of diversification, how long-term versus short-term goals should lead to different investment approaches, and why market conditions should inform regular portfolio maintenance. Since not all of your assets are concentrated in one area, diversification enables you to benefit from possible growth in one sector without suffering too much loss if another declines. Importance of a diversified portfolio. Diversification, or spreading your money across multiple investments and investment types, ensures that your money stays safe if one or a few assets suddenly dip, since those in other industries can compensate for loss and maintain balance. The first step in investing is to select various asset types, such as stocks, bonds, and mutual funds. Further diversification is possible and advised, including adjusting investments according to industry, region, and company size, among other things. According to Tanza Loudenbach, CFP, a former insider personal finance correspondent, the type of stock you own counts more than its quantity. Loudenbach advises that your equities, whether you hold 5 or 250, should represent a variety of sectors and businesses. If someone owns 5 tech stocks, for example, they might be happy when Apple reports stellar earnings and their stock goes up. Apple stock represents 1/5 of their portfolio and it makes a meaningful impact. But this goes both ways. If manufacturing of the next iPhone is interrupted and the Apple stock goes down, their portfolio is in jeopardy. The greater number of diverse stocks a portfolio has, the less impact one of those stocks has on the whole thing, she says. How to diversify your portfolio. Consider time horizon. Longer-term objectives typically enable higher risk because liquidity isn't a major concern. For instance, a long-term objective like retirement planning allows you to invest in riskier industries like commodities or real estate since it allows for some short-term volatility. Short-term objectives, such as creating a rainy day fund, have a lower risk tolerance and may encourage you to invest in less risky securities like bonds or money market funds. Maintain your portfolio regularly. Maintaining your portfolio on a regular basis can help you stay on pace to meet your savings goals as particular assets in your portfolio outperform or underperform. Rebalancing your portfolio once or twice a year will do just that. Keep tabs on your investments and the general state of the market to determine when it is appropriate to trade. Watch out for fees. A professional managing your portfolio is almost certainly going to charge you commission or transaction fees. These may accumulate as your portfolio gets larger, preventing you from saving money as rapidly. When making a savings plan, remember to include costs and keep an eye out for any changes to the charge schedule. How often should you swap stocks out? Depending on your objectives. A regularity of once or twice a year is ideal if you want your portfolio to last you into retirement and have a long investing horizon. If you only want to hold stock for a brief period of time, you might rebalance more frequently, such as once per year until you meet your goal. Rebalancing involves buying and selling specific stocks to match your goals. To avoid paying short-term capital gains taxes, it's generally a good idea to hold all of your assets for at least a year. Anything you own for less than a year is regarded as short-term for tax reasons. You should therefore anticipate holding onto your stocks for at least a year, and possibly much longer, depending on what your future intentions are for your money, unless it is worthwhile to pay those taxes. How many stocks should you own for a diversified portfolio? You're probably familiar with legendary investor Peter Lynch, who gained his considerable fame managing Fidelity's Magellan Fund. The fund earned an annualized return of 29% during his 13 years running it, more than twice what the S&P 500 earned during that time. Mr. Lynch is well known for his book, One Up on Wall Street, where he explains that individual investors can outperform fund managers because they are unencumbered by short-term performance concerns and bureaucratic rules. During his tenure as manager of the Magellan Fund, Lynch held as many as 1,400 stocks at some point. Such a large number didn't prevent him from creating outstanding alpha, but it's essential to understand that he did not invest in new businesses in an effort to be more diversified. He simply invested in a compelling investment every time he came across one. This distinction is essential. Lynch believes investors should own however many exciting prospects that they are able to uncover, and that pass the selection process. In short, while you could have not enough stocks, there is no such thing as too many, as long as you have the right filtering process. But make no mistake, Lynch clearly thought about portfolio construction with diversification in mind, focusing on being spread across many industries, company size, and growth potential. Ultimately, reducing the volatility of a portfolio should not depend on the number of stocks in the portfolio, but the overall portfolio construction and the investment selection. Investing in multiple uncorrelated assets is a powerful way to limit portfolio drawdowns without necessarily compromising your potential returns. Ultimately, reducing the volatility of a portfolio should not depend on the number of stocks in the portfolio, but the overall portfolio construction and the investment selection. Investing in multiple uncorrelated assets is a powerful way to limit portfolio drawdowns without necessarily compromising your potential returns. There is no magical number in how many stocks you should own, but it is generally agreed upon that investors should diversify their portfolio over the sectors they want exposure to while keeping a healthy allocation in fixed income instruments to hedge against an individual company or sector downturns. This usually amounts to at least 10 stocks at the very least. How many stocks and bonds should be in a portfolio? Diversification is a portfolio's greatest asset. In addition to superior long-term returns, diversification makes it easier to manage risk and weather market downturns. Due to these factors, you'll need a variety of stocks in various industries that can counteract one another. A small number of companies is not going to provide enough broad diversification, says Blackwell, who speculates the average investor would need a double-digit number of stocks of appropriate diversification. According to Liz Young, head of investment strategy at SoFi, anything under 20 is highly concentrated, and at that point, you're exposing yourself to single security risk. That suggests that every time a certain sector or firm changes its pricing, your investments could fluctuate by significant amounts. According to several analysts, the sweet spot for manageability and diversification for the majority of individual stock portfolios is between 20 and 30 stocks. But if you look further than that, other study has identified 60 stocks as the magic number. A study completed from 1986 to 1999 by Ronald J. Suez and Mitchell Price of Roxbury Capital Management Investment Firm in California found that when portfolios have 60 stocks or more, investors will achieve 89% diversification, meaning your portfolio is protected against volatility. Anything less than that can be detrimental to your portfolio, the research found. But really, the answer depends on the approach you adopt in your asset allocation. If you take an ultra-aggressive approach, you could allocate 100% of your portfolio to stocks, being moderately aggressive. Move 80% of your portfolio to stocks and 20% to cash and bonds. If you wish for moderate growth, keep 60% of your portfolio in stocks and 40% in cash and bonds. Finally, adopt a conservative approach. And if you want to preserve your capital rather than earn high returns, then invest no more than 50% in stocks. A good rule of thumb is to scale back on the percentage of stocks and increase your high-quality bonds as you age, in order to be better protected from potential market downturns. For example, a 30-year-old investor would hold 70% in stocks and 30% in bonds, while a 60-year-old would have 40% in stocks and 60% in bonds. And that's about it for today's video. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!